Bloomberg Audio Studios. Podcasts, radio, news.
We're now going to bring in David Kostin. He's Goldman Sachs' chief U.S. equity strategist on the latest price target increase for the S&P 500. Because, of course, David, really interesting here. This is by far not the first time you've done this year. At what point do tariffs become problematic for you?
Well, the idea of tariffs are baked into our forecast right now. We're looking for earnings growth this year of around 7% and earnings growth in 2026 also of around 7%. And investors are now starting to turn their attention into next year's earnings. I know we're only early part of July of 2025, but the investment analysis looks into next year and discounts that back. So the idea of tariffs, we're assuming somewhere in the mid-teens, likely to be the final level. The effective rate for tariffs last year, as you know, was around 3%. It's already up in the low double digits right now, but the real insight will probably be later this year when we'll have sort of a run rate level of tariffs. But from our perspective, the market investors are sort of thinking about the mid-level of mid-teens, and that's probably what's going to support an earnings growth of 7%, and that's why the market moves higher.
Companies seem to have, Nir Kaysar wrote for us at Bloomberg Opinion, really fat margins right now, so they can absorb to some extent these tariffs.
I want to think about it the following way. In the last 30 years, margins have gone from 5% to 12%. That's net margins for the S&P 500, 5 to 12. What are the driving factors of that? What are the building blocks? Lower cost of goods sold, lower COGS, about 5 percentage points of that improvement in margins comes from there. Lower tax rates, another reason. Lower interest expense. Those are the reasons why margins have moved higher. And so we look out in the next couple of years, tariffs are a way of increasing the cost of goods sold. That's a downward pressure, likely to be a downward pressure on margins. Some of the debt that's rolling over for some companies is actually rolling over to higher level. And so, Matt, the way you want to think about this is the tariffs are a downward pressure, and then who is going to pay for those tariffs? Is that going to be the suppliers? Is that going to be the consumer? Who's going to pay for that?
What do you think about the effects of one big, beautiful bill? Now that we have it, and Stephen was obviously a huge part of creating that legislation, now that we have that certainty, and now that investors can calculate, put it into their models, is it a good thing?
Well, I think the clarity, as you just referenced, is really the important thing for portfolio managers and for corporations. Corporate executives thinking about capital spending decisions, dividend policies, things like that, all are enhanced when they have some clarity on what the policy is likely to be. So in that regard, the fact that it was passed means we can look forward and see what are some of the fundamentals. And the idea the economy is decelerating but still growing is an important backdrop. And the idea that the Fed is likely to be cutting interest rates 3 times, the Goldman Sachs economics forecast, 3 times starting in September, twice next year. That is an environment where bond yields are likely to also be lower. 10-year Treasury yields probably around the 4.2%, and that supports our forecast of around 22 times multiple for the S&P 500. So that valuation, which is current today, we think forward earnings growth 7%, that lifts the S&P 500 in our view to 6,600 by the end of this year, 6,900, 6,900 by middle of 2026 or next 12 months. That's the general backdrop. Again, the clarity on policy is important, and now investors have moved beyond sort of this year, really beyond the tariff discussions. The view is it will be eventually resolved, and what's the general thrust of business?
You can make an argument that some of the market has already been looking beyond some of the current policies, trying to feel the impact of deregulation, lighter regulation. KBW Bank Index now up more than 12%. It's almost Super Bowl, right, aka bank earnings next week. And so that'll kick off. This earnings season will be really interesting to watch. Every single bank except one in the KBW Bank Index is up on the year. Have we seen the best it's going to get?
I think one important aspect to think about, we've had an incredible 25% rally in the last 90 days. A 25% rally in the S&P 500. It is a really, really narrow breadth market. It's really led by some of the largest companies in the market. That's fine, but the idea of the median stock, the typical company, is down 11% lower than its 52-week high. If you look at the mid-cap stocks, you look at the Russell 2000, these stocks are down basically 10%, or they're trading 10% lower than their 52-week high. As a consequence of that, the idea of some opportunities in these other sectors are where we are focusing our discussions with portfolio managers. The alternative within the financial sector, banks have had a terrific rally, as you just referenced, a lot of dividend increases once the CCAR results came out. And so what are some of the areas within the financial community that have lagged relative to our model? And the alternative asset managers are certainly one category that we focus on.
What do you think about the Fed path? As you pointed out, people are already looking to 2026, right? And at that point, President Trump is going to be able to put very likely a yes man, right? Someone who wants to cut rates dramatically in the chair. Do you expect that person to be able to push those cuts through? I mean, are you looking at 3 percentage points cut in 2026?
Well, what matters more for the stock market is real interest rates, real 10-year bond yields. So you think of nominal yields, we're looking at something in the vicinity of about 4.25%, which is supportive of a valuation, as I indicated, around 22 times forward multiple. And that is the area that investors in the equity market are probably more focused on than specifically the path of the Fed policy. Now, our baseline forecast is you're going to get, because inflation is going to come lower, the economy is going to still grow, and the Fed has that capacity to be lowering rates. So that's the general path that we're anticipating, and that supports the market generally moving in a positive direction at this juncture.
So I'm going to ask our producers to pull up a chart, #BTV4400. This is a Bloomberg Intelligence analysis of the top 20 or so firms that have benefited the most from tariffs and the bottom most impacted, like the worst performers, the ones that are most impacted by tariffs. The divergence is real. There has been a bounce back from the bottom of April. However, the best performers have been up almost 20%. The worst performers are still down almost 5%. How does Goldman think about this in baskets? What does well, and do the ones that have not performed well, do they continue to lag into next year?
Well, the idea of margins is at the core of investor discussions right now that we have, which is who's going to pay for those margins? Is that going to be the supplier? Is that going to be the corporation absorbing them? Is that going to be the consumer at the end of the day paying for that? And historically speaking, it's the consumer that ends up absorbing much of that cost. And now a lot of companies advanced their inventory at the beginning, so that makes the analysis a little bit more complicated. When you look at the share prices that you just showed in your graph, that could be complicated by the idea of this is how the share prices are performing. What about the fundamentals? And we're going to kick off next week on the 15th of July with all the bank earnings. And the next six weeks or so, we'll have much more clarity in the question of how is it that companies are dealing with these tariffs. Remember, the tariffs only partially were applied during the second quarter. So the second quarter still is uncertain. Now it's been pushed out in many cases really until maybe perhaps August 1st. So there's still a transition process here. But in terms of those stocks, there's certainly a lot of questions as to who's going to pay for the tariffs. And our view generally is the consumer. It's going to be ultimately passed on to the consumer. You
were here for an historic event, David. NVIDIA passed $4 trillion in market cap. We've fallen back a little bit below that, but we're there. And we've seen this company and this industry power the U.S. stock market higher for 3 years now in a row. How much more room is left for this gold rush to continue? I mean, where do you think we are if you were to compare AI opportunity to a baseball game? In what inning are we right now?
Well, let's think about that in baseball game. There's sort of phases of that. If you think about phase 1, 2, 3, and 4. NVIDIA is absolutely in phase 1. We'll call that the early innings that are necessary in order to build out the infrastructure. That's the leading edge of the infrastructure. But then you have the utility companies, you have other semiconductor companies, you have some of the hardware companies. That's sort of the second phase on the infrastructure. Now, where we are, I would say, is we're 2.5 years. November of 2022 is when ChatGPT was introduced. We're 2.5 years in. We'll say perhaps that whole transition process is maybe 5 years. So we're sort of halfway. So first to answer your question, maybe we're halfway through one scenario. And so you've gone from the leading edge, NVIDIA, you've had the infrastructure, now you have the applications. And most companies, when we talk to most companies and ask how is it that they're using AI, they're still looking for getting their data codified in a way that can allow the AI, generative AI, perhaps to make them more efficient. So that's the third phase. And the fourth phase is what's the long-term implications for corporates. And so another way of sort of summarizing this is the transmission mechanism for AI through the margin channel, better margins, more efficiency, or is it through the revenue channel? Is that companies can boost their output and get better sales? Mm-hmm. And there are different companies that are going to benefit or be different ways in which they can benefit. And so this is one of the things that I find most surprising is that only half the companies in the S&P 500 chose to discuss AI on their quarterly conference calls. Only half. The other half chose to, we're mute on the subject.
David, we got to leave it there. We're hitting a hard break. That is David Kostin of Goldman Sachs. I know you're on the road a lot, so appreciate you joining us here in studio.